All right, former Fed official Bill Dudley clarified his thoughts from last week's op-ed on how the Fed should behave going forward. In a Bloomberg opinion piece, Dudley wrote, "The Fed needs to be cautious that it does not inadvertently enable the president's trade war with China. I was suggesting that if the Fed pushed back, that it might be able to achieve a better economic outcome. I was not suggesting that the Fed should do so regardless of the consequences for the economy or that it should stand by and allow a recession." Well, we're joined now by Sandip Bhagat. He joins us from South Pasadena, California. He's Whittier Trust CIO. Sandip, good to see you. When we look at this sort of talk surrounding the Fed, whether it's Bill Dudley suggesting one thing, we have various Fed officials also coming out, weighing in on whether the Fed should cut 50 basis points, for example, at the next meeting. What are you betting on as an investor here?
These are really confusing times for the Fed and driven mainly by this hopeless dichotomy in global growth. The US economy is strong, the rest of the world is not. We are less dependent on trade, the rest of the world is not. And so the question for the Fed is, to what extent do you pay attention to fundamentals in your own domestic economy? And what attention do you pay to forces outside the US? Because we still live in an interconnected world and there is the risk of a contagion effect. And if this wasn't bad enough, what do you do with political pressures? Do you give in to those and ease more dramatically than you might have? Which in turn, to make this even more perverse and complicated, would embolden the very tactic that caused the divergence, caused the trade war. So these are really difficult questions to answer. My counsel, my view on this is it is imperative that the Fed stay independent. And given a choice between paying attention to the domestic economy and the foreign economy, maybe start at home. So putting all this together, the Fed has clearly pivoted. There is no mid-cycle adjustment. They will cut more. There'll be nothing dramatic. We'll see a 25 basis point cut and then maybe one more.
You don't think James Bullard, who is calling for, a 0.5% cut, kind of a shock and awe, might get what he wants?
Look, the stage has been set through the escalation in the trade war. Inflation is also conspicuously absent. So 50 basis point is defensible, more as an insurance policy than anything else. But quite seriously, whether we do 25 each in two separate meetings or 50 in one fell swoop, it really doesn't matter. The US economy is strong enough to withstand any reasonable action that the Fed comes up with.
You mentioned the global nature of the market, and I'm just curious what you think the yield curve is telling us right now, because do you think the yield curve is truly signaling a recession like it had done in previous times, or is it just because of this global flight to safety, because of the trillions of dollars of negative yielding debt overseas?
So there are these international drivers that put US Treasuries in demand. Look, there is some information about future growth. There is no denying it. We're in a soft patch. We are experiencing a slowdown. But keep in mind that the term premium, that component of the yield curve that is compensation for risk, that has been progressively coming down. And that element, I think, is compromised. It is distorted by some unusual factors. You talk about the flight to safety. The cost of safety has gone up. We suspect that the bond market is actually quite overvalued because people are paying such a high price for safety. With negative yields overseas, US Treasuries at 1.5% look attractive. Keep in mind that inflation expectations are very low. That is the unusual characteristic of this expansion. The economic cycle is getting more stable, more extended. It's less risky to begin with. So this term premium component is coming down. And don't forget, you have the central banks implementing QE, which is the outright purchase of long-term bonds. So these aspects are distorting the yield curve, and therefore it may not have nearly the same content, same signal or information about a recession that it might have in the past. Sandip, we think it's signaling slowdown, not a recession.
Sandip, what are your expectations of, say, the 10-year Treasury? I mean, some are even speculating now that you might see a negative yield on the 10-year. We're not there ourselves, but we do see yields dropping further. And we think that the long-term implications for investors, in particular the baby boomers who are retiring and are dependent on an income are quite significant.
Yeah, this is your classic financial repression, right? This is penalizing the savers and benefiting the lenders. We are of the opinion that the bond market is actually overvalued. It is pricing in such a dramatic slowdown that both a global recession and a US recession is a realistic possibility from the bond market's perspective. We don't see that outcome, especially in the US. And I think if that realization gains traction, the yield curve might well steepen. So we're actually calling for it to go the other way instead of heading closer to zero.
Interesting. All right, Sandip, thank you. Sandip Bhagat of Whittier Trust. Appreciate it.